The dot-com bubble was an economic bubble that occurred between 1995 and 2000. It was characterized by a frenzy of investment in internet and technology companies. The bubble formed as a result of the rise of internet technology, which led to a widespread belief that internet companies had immense potential for growth and profitability. This belief fueled a surge in investment in internet stocks and other technology companies. However, many internet companies failed to generate profits and their stocks were trading at inflated valuations. This eventually led to the bursting of the dot-com bubble. What was the dot-com scandal and when did it occur? How did dot-com act contrary to legal or ethical restrictions and how was it unveiled? Which industries or economic sectors were affected by the dot-com scandal? What were the consequences of the dot-com scandal and who was affected? What measures did the government or other institutions take following the dot-com scandal, and how effective were they? For all this and more, before starting the video, if you're interested in universal economic history, you can subscribe to my channel and turn on notifications to be informed about new videos I upload every day. Enjoy the watch.
Universal economic history.
The Nasdaq index is a stock market index that represents the performance of the largest technology companies in the United States. It is closely associated with the dot-com bubble as a significant portion of internet and technology stocks were traded on the Nasdaq exchange. During the dot-com bubble, the rapid increase in internet and technology stocks significantly boosted the value of the Nasdaq index. Many investors saw great potential in Nasdaq-listed stocks and invested heavily in them to seek high profits. During the dot-com bubble, there was a surge in investment in internet and technology companies. Many investors believed in the immense potential of these companies as new technologies, particularly the internet, emerged. This belief led to a rapid increase in stock prices, enticing investors to pour in more money in hopes of higher returns. However, a significant portion of internet companies failed to generate profits, and their stock prices were trading below their actual values. This discrepancy eventually led to the burst of the dot-com bubble. The increasing usage of internet technology worldwide elevated the importance of internet companies. Companies like Amazon, Facebook, Google, and Apple experienced rapid growth driven by technological advancements and achieved multi-billion-dollar market valuations, placing them among the largest corporations. These companies' high valuations raised eyebrows among investors and critics. However, their valuation was rooted in intriguing business models. These companies made money by establishing their businesses and obtaining high valuations. Amazon is one of the most well-known examples in terms of business models. The company started with selling books and electronics but expanded its product range to encompass millions of items sold worldwide. Amazon primarily generates revenue through its online retail platform and also offers Amazon Web Services, Oz, a cloud computing service that generates significant income by providing this service to other companies. Facebook began as a social media platform and evolved into an advertising platform where numerous businesses advertise their products and services. Facebook funds its operations through the revenue generated from advertising. Google began as a search engine and advertising platform. The company expanded its services and developed an extensive ecosystem, including the Android operating system, Google Maps, and other services. Google's revenue comes primarily from advertising, and it also offers a variety of digital services. Apple started as a computer company and later introduced iconic products such as the iPod, iPhone, iPad, and more. Apple earned significant revenue from hardware sales and through services like the iTunes Store. While internet companies face significant risks, including competition, innovative technologies, government regulations, and other factors, their business models allow them to capitalize on opportunities created by new technologies, enabling them to maintain success in the future. The burst of the dot-com bubble resulted in a significant collapse of the stock market, affecting not only internet company stocks but also the broader technology sector. Many internet companies experienced sharp declines in their stock prices, leading to substantial losses for investors. The bursting of the dot-com bubble can be attributed primarily to overvaluation. Internet company stocks were traded at inflated prices due to high growth potential expectations. However, the growth potential of many companies was exaggerated, resulting in overpriced stocks that eventually led to the bubble bursting. Another contributing factor was the weak business models of many internet companies. Despite high valuations, numerous companies struggled to generate profits and were financially unsustainable. As a result, many companies went bankrupt or incurred significant losses. Additionally, the rapid growth rates of internet companies were unsustainable. Many companies relied on substantial investments to acquire new customers and needed high growth rates to recoup those investments. However, such rapid growth rates were not sustainable in the long run. As a consequence, the burst of the dot-com bubble caused a significant collapse in the stock market, impacting a wide range of investors. However, as a result of the burst, internet companies were forced to develop more robust business models, which enabled them to achieve sustainable growth and success in the long term. After the burst of the dot-com bubble, many internet companies went bankrupt or faced substantial losses. However, some companies managed to survive and continue their operations to this day. So, how did these companies survive? The burst of the dot-com bubble revealed the weaknesses in the business models of internet companies. Some companies managed to survive by developing more sustainable business models. For example, Amazon started with book sales and expanded its business to encompass e-commerce, cloud computing, streaming, and other sectors. The burst of the dot-com bubble led to significant losses for many internet companies due to overvaluation. To survive, these companies had to cut costs. For example, Google reduced internal costs, improved efficiency, and managed to weather the storm. The burst of the dot-com bubble resulted in a significant reduction in advertising and marketing budgets for internet companies. However, these companies adapted by implementing more effective and targeted advertising strategies, reducing costs. Facebook, for instance, adopted targeted advertising and sponsored content to improve its marketing approach and remain viable. After the burst of the dot-com bubble, investment in the technology sector declined. However, some companies survived by investing in new technological innovations. Apple, for example, continued to innovate with products like the iPod, iPhone, and iPad, strengthening its position in the market. The burst of the dot-com bubble also highlighted the importance of companies forming strategic partnerships to survive in a competitive market. Many companies realized the need to collaborate and expand their customer base. These partnerships helped companies access new markets and generate additional revenue. The burst of the dot-com bubble resulted in significant losses for investors and highlighted several important lessons and insights. Here are some key takeaways. Avoid excessive optimism about market conditions. It is crucial not to succumb to excessive optimism and to carefully assess market conditions and valuations. Focus on a company's real earnings and cash flow. Rather than solely relying on future potential, it is important to consider a company's actual earnings and cash flow. Avoid speculative behavior. Investors should be cautious of speculative behavior and not blindly invest based on potential future valuations. Establish sustainable business models. Companies need to focus on building sustainable business models that prioritize profitability and long-term viability. Monitor market conditions. Regulatory bodies should actively monitor market conditions to prevent excessive speculative behavior and mitigate risks. Exercise caution when investing online. Online investments carry risks such as fraud and scams. Conduct thorough research before making any investment decisions. Avoid a short-term focus on returns. Instead of seeking short-term gains, adopt a long-term investment strategy that minimizes risks and aims for sustainable returns. Seek guidance from professional investment advisors. Professional investment advisors can provide valuable insights and help navigate market conditions and investment strategies. In conclusion, to protect themselves from technology bubbles, investors should conduct thorough research and analysis, diversify their portfolios, focus on a long-term investment strategy, monitor market conditions, exercise caution when investing online, and seek guidance from professionals. Thank you for watching my video. If you liked it, please hit the like button. If there's a specific video you'd like me to make on economic history, don't forget to mention it in the comments section. I wish everyone a pleasant day.
Universal Economic History.